All right, what's up, everybody? This is Faris Sleem with the Bowser Report monthly stock newsletter. I wanted to put out a quick video today highlighting the pros and cons of investing in penny stocks. In the past, we've done a lot of different videos and blog posts on just the benefits, but I wanted to kind of go into this unbiased and also tell you some of the downsides and really how to avoid taking losses with penny stocks. Okay, so we're going to start it off with the pros, right? Start it off on a positive note here, but the first pro of investing in penny stocks being low starting costs, right? We have a very extensive YouTube video on this. I'll link it in the description and on the video itself. But basically, when you're managing a portfolio, you're managing a business, right? You want to keep your expenses low. You want to keep your profits high. So as an entrepreneur, right, your goal is to not invest too much right off the bat, right? You want to kind of ease into it and diversify. And manage risk to the best of your ability. Lower starting costs means that you don't need $25,000, $50,000, $100,000 to invest, right? It's not the case anymore. That was the case years ago, right? If you want to invest in some of these larger companies, but now with technology being what it is and with brokerages moving all of the commissions for the most part down to $0, right? Just making them free. It's a lot easier to get started. So we have a video talking about this, but essentially you can get started with 1 to 2K and really diversify accordingly. You can get started with less, but you won't be able to have as many positions. So you'll be adding risk, right? Because when you have more positions, right, a diversified portfolio, if one of them takes a hit, so we can even write this out real quick. Let's say I only have a portfolio of 3 stocks. Right? Not 3 shares, but 3 different stocks. And one of them takes a hit. It sinks, 30%, whatever it may be. My total portfolio value is going to get crushed, right? But if I have 4, 5, 6, 7, 8, which is what we typically recommend as a minimum, 8 holdings, then if stock number 1 goes down, we're not going to take as big of a hit. So the lower starting cost kind of plays into risk management a good bit, where you don't have to have as much capital at risk. Okay. Number 2, and this is the big reason why people jump into penny stocks in the first place, higher reward, right? Obviously, there is risk that comes with this reward. We're going to talk about it in the cons section, but you see it every day. And if you've been a Bowser Report subscriber in the past, we've had a ton of winners, even this year alone, right? We're only in the second month of 2020. We've already had a stock double. It's gone up over 100%. In 2019, I think we had 6 total recommendations double. So naturally, you look at this and think, oh my God, 100% gains. That's such a great reward. Why don't I just dump all my money into penny stocks? Pause it, right? Rewind, bring it back a little bit. We have a lot of different principles that we preach, such as risk management, sticking to a game plan. So most people jump into this thinking that they can just make a quick buck. Our goal is to kind of provide the analysis for you, but also have you understand the full investment process. So when we're talking about higher reward, your goal isn't just to make a quick buck. Your goal is to build your wealth long term so that you have a little nest egg for yourself. Okay, penny stocks offer better reward, but at times more risk, because they do have risks that are not really that common with blue chip stocks, right? For example, let's compare Apple to any given recommendation, right? Let's even take one of the better recommendations, KRMD, right? KRMD used to be known as ReproMed Systems. Okay, they are nowhere close to Apple in terms of size, right? Arguably, KRMD has better financials, a better growth rate, better everything, but they just do not have the resources that Apple has. So if they were to get hit with a big lawsuit, even if it had no credibility behind it, if there was some kind of black swan event where they lost a major company as a customer, right, that would crush the stock. And even though this stock did well for you, even though it's already up, thousands of percent from our alert back in 2010, right, we're long-term investors here, that could still significantly affect and negatively impact your portfolio. So we talk about higher reward, but in general, there are a lot of risks that come with that. Okay, and we'll get into it in a minute. Third pro, and I know there are a lot more benefits than this. These are just the big 3 for me. As somebody who's actively investing and passively investing long term, right, with some of these Bowser Report stocks, I love getting involved. The best thing about these smaller companies that you won't get with Apple, right, is you have the ability to call up management and say, hey, what the hell's going on here, right? Why didn't you guys have the revenues that you were forecasting? What happened to this customer? What exactly can we expect moving forward? Usually management is pretty nice about that. So I'm talking about executives, right? You can get on the phone with the CEO in a lot of these instances. They're very open to answering any questions. They got nothing to hide. Usually they're really transparent. They'll help you out every step of the way. You can't ask everything, though. I feel like I have to say this as a little bit of a disclaimer. You can't ask every single little detail about what's to come in the future, because legally they cannot provide all of that information, right? They can hint at things. They can kind of give you financial outlook, but it's going to be what's already publicly stated. It's all public information. They're not going to give you any insider info that's going to help you get an edge, right? But the idea is that you get involved. You get an idea of how the company functions. You get to be buddies with management, right? So if you have any questions, you get to hear it from the horse's mouth, right? Which is the most credible source. And there are no questions, right? You don't have any type of gray area that you're not sure about with that investment. Whereas Apple or Amazon or any one of the big tech companies, you can know them inside out, but at the end of the day, you don't have any say in what happens with the company. You can't make any decisions based off of what the company does. There's very little wiggle room, right? So you can understand it to the best of your ability, but you're never going to understand it and be as involved as you could be with one of these small caps. Okay, so personally, before I recommend any Bowser Report stock, any penny stock, I call up management and I ask them questions. I always have questions, right? Even if I have some kind of source on the internet for that, right, one of these platforms tells me that, I'll still have questions at the end of the day. So it's good to get answers for those. Okay, so just a review, low starting costs. You don't need that much money to get started. Higher reward, which is what everybody loves to talk about. And you actually get to get involved. Okay. Now, moving forward for cons, one of the things that I think, and again, it's different for everybody, it really encourages greed, because if you see a big percentage by one of your portfolio holdings, so if a stock is up 80%, you start thinking, well, what if it can be 100%? What if the stock under it on that list could be 200%? And you get very, very greedy. I think penny stocks, since they are more volatile in general, right, which is also a risk, we're going to talk about that, tend to encourage an unrealistic mindset of what each and every position is going to earn you. They also tend to kind of give you that get rich quick mentality, right? It's the same thing with stock options. If you've ever traded those, it's the same exact thing, right? Stock options, while can be very lucrative, right, require more risk, and they encourage greed because you can have a large percentage gain in a short period of time. Okay. Now, second on the list is liquidity here. Liquidity is just with regards to volume, and I'm sure a lot of you guys are already aware of how that works, but just in case you aren't, we're not talking about a stock getting high volume in general. What we're talking about is high volume coming in consistently. Right? Meaning that there's sufficient volume flowing through the stock. There are enough people trading it. There are enough shares being traded for you to get in and out without having any issues. It's the worst thing ever when you go to sell a stock and let's say, you know, people are bidding $1.90 per share and you're exiting a profitable position. This is what the bid is at. That's what people are willing to pay. The ask is $1.95, right? Let's say that you're unfamiliar with how orders work, or you just use basic market orders, which I actually do not recommend. We have another video on that as well, when we talk about stops extensively. But let's say you're just using a market order, and right before you click sell, that person cancels their bid. You know, it's not the most uncommon thing. It does happen. In that case, you get filled at $1.85, and you just put a big dent in your gains. Right? That happens a couple of times. You're looking at a lot of money lost just by carelessness and trading a stock that does not have consistently high volume, right? So when you're investing in these stocks, it eliminates risk, right, substantially if you're investing in ones that have high consistent volume. Our bare minimum is 2,000 shares a day, but honestly, right, based off the size that you're investing, you want probably about 10K shares a day. Okay. Another big downside is chasing what's hot. It's funny because one of the things that always pops up as an advertisement to me is hot stocks to trade, penny stocks that are hot right now. Usually with penny stocks, if they're hot, they're already discovered. People have been investing with them for quite some time. And our goal isn't to, uncover some kind of hidden gem, rather to just focus on our game plan, right? Buy the stocks that we want to buy at a decent price. If a stock is hot, chances are it's overpriced, right? Because the awareness for it is that much higher. So a stock that is trading at $2 normally, based off of its book value, based off of all the different catalysts priced into it, could be trading at $3 if more people know about it, if it's a hot stock. So if anything, you should avoid hot stocks, right? You should kind of just take that out of your vocabulary. Focus on the stocks that you want, the underlying companies, at the value that you want to pay for them. So if I like stock XYZ at $1.50, I'm not going to pay $3 just because it's moving up fast, right? If anything, you would wait for the pullback, okay? And then the last con, and the big one, is higher risk in general. So again, these companies, while we do pick the most financially stable ones, don't necessarily have the resources of the big boys. There's a lot more risk involved typically. Even if they're doing well as a company, they have consistent revenues, a great balance sheet with little debt, there's still risk, right? As I mentioned, they lose a big customer, they lose a big contract, that could result in a big hit on the stock price, and sudden. You don't have time to get out typically. Okay, so with that being said, I highly recommend, if you haven't yet, right? I know the Bowser Report is a paid newsletter. It's just a few bucks a month, but this is throwing payment aside, right? The best investment you can make is in yourself, but investing your time is more valuable than investing your money. Watch the free video that we have on YouTube about the Bowser game plan, how to invest in penny stocks. It goes over our game plan, how we manage risk with stop orders, and how we take profits. Because a lot of people just think about risk management to the downside, right? Using stop orders, cutting losses, right? When in reality, a lot of it is taking profits. So locking in your gains at a certain percentage return. Okay, so we talk extensively about that, but basically, the best way to get around this downside is just sticking to your game plan. Create a game plan for each holding, stick to it. Sounds like a lot of work, but again, it's managing a business, essentially, right? So just to kind of wrap this up, keep it nice, short, and sweet. Major takeaways, first things first, completely cut out that get-rich-quick mentality. Invest in penny stocks for the long run, right? If you are trading actively, I day trade in my free time as well. Well, I actually day trade for a living. So I am fully aware of how easy it is to just drink the Kool-Aid and get caught up in the hype and trade some of these penny stocks actively. But what we're referring to here is long-term investments, building your wealth, not getting rich quickly. So if you even have the tiniest notion of trying to get rich quick, it will turn around and bite you. Okay, it will come back to hurt you, whether that's based off of risk management or not taking profits, whatever. It'll come back. Okay, don't drink the Kool-Aid. This means don't chase hot stocks. Don't believe the hype. Just trust your process, right? If a stock is trading at 150 and it's worth $2 and you read online that it should be worth $10, right? Don't drink that Kool-Aid. Leave it alone. Focus on your game plan. You want it to go up to 2. Okay. And the last thing goes hand in hand with both of those. Focus on your game plan. As long as you're trusting some kind of process, you don't need to hear any other noise. Just filter it out, right? As long as you're focused on yourself and the underlying companies that you're invested in, you'll be fine, right? If you're basing your investments off of speculation, that can be a problem. That's kind of the gray area here. But in general, if you're investing in solid companies with good financials and strong outlook, you're good. You don't need to worry about anything. And those gains will really add up. Okay? So don't try to get rich quick. Don't drink the Kool-Aid. Focus on your game plan, and it will really exaggerate these pros for you. and it will pretty much entirely eliminate these cons. Okay, if you guys have any questions or anything to add, right, if there's a pro that I missed, because I know I left out a lot, just to keep it simple, feel free to throw it in the comment section below. And if you like the video, like and subscribe. Okay, thanks so much, folks. Have a good one.